Thanks for watching. This is Investing Basics. Before we begin, I would like to state that this presentation should not be used as investing guidance. It is simply knowledge information and should not be used as financial advice to anyone. And also, this presentation was made to show different kinds of investments available. Thank you. Like I said, there are many different kinds of investments available, such as savings, money, bonds, stocks, overseas investing, precious metals such as gold and silver, real estate, and annuities. I will go ahead and briefly describe each investment type. Let's begin with savings, money market accounts, which are found at your local bank or any bank that you prefer. These accounts are insured and pay an interest rate, also known as a yield on your initial investment. Because this investment is less risky than any other investment types, it pays a lower yield. Therefore, you don't sponge up or take a larger risk. Also, these accounts are insured by FDIC, so if the bank goes into default, the peace of mind is that you have insurance. Another investment type I have is bonds, available at any trading broker. There are many different types of bonds. Cities and states can issue bonds, called municipal bonds, and also corporations can issue bonds, known as the corporate bonds. When you buy a bond, you act as a bank. You lend the company, the city, or the state your money and receive an interest on your investment on maturity date. What's nice about bonds is before you purchase any bond, it will provide you valuable information such as maturity date, the yield it pays, and the minimum investment. Therefore, you can use that information and, depending on your broker, an onboard calculator to find out exactly how much you will receive with that type of investment on maturity date. The most common investment is stock and mutual funds. Each company that is traded publicly will have a ticker that is listed on a major index, such as, for example, XYZ or ZYX. Not necessarily 3 letters, it can be 1, 2, or 3 letters and so on. By watching any news or any TV channel, you may find the ticker bar on the bottom, left, right, top, displaying the tickers of each individual companies. It will display things like the gain or loss for the day, for the month, or yearly gain or loss might be shown in dollars or percentages. Buying individual stocks, you must remember, for each time you buy an individual stock and each time you sell an individual stock, you pay a commission to the broker. So therefore, a frequent trading will be a nice chunk paid to the broker. Mutual funds are a basket full of different stocks. There are many different mutual fund companies that specialize in different types of stocks. Some are international, some are local, some are tech, and some are oil and energy. By investing in a mutual fund, you have less risk if a company goes into default, closes its doors, or goes bankrupt. Keep in mind, there are many you invest in at the same time, many companies and stocks you invest in at the same time when you buy a mutual fund. When you buy an individual stock, and if that company goes default or closes its doors, you lose 100% of the investment, versus a mutual fund that has, let's say, about 10, 20, or whatever the number is, companies and stocks in their portfolio. If one of those goes into default, that will slightly drive down your portfolio. If any at all, negativity will show. If one goes into default and 19 go positive, you might not even see the negativity on your portfolio. Let's not get too into details since this is just the basics. The next one is overseas investing. Could come from buying an individual stock, an individual company that is located in a different country. You may also buy a mutual fund that specializes overseas investing. But keep in mind, before investing overseas, you must know the country's economic status and condition, along with their trading laws. The next one is real estate. It's pretty self-explanatory. Buying property on borrowed or non-borrowed money and renting the property out for a monthly profit. Some studies show that return on real estate is somewhat from 5 to 10%. Don't quote me on that. And if you choose not to deal with buying the property and all the hassle and finding someone to move in, You may purchase a mutual fund that deals with real estate and benefit from their profits. The next one is precious metals, such as gold, silver, and so on. This type of investment provides a smaller return, but they provide a hedge against inflation. You may choose to buy an actual physical gold and physical silver, or you may buy a stock in gold and a stock in silver. The final in my presentation is annuities. They provide somewhat a higher yield that is backed by insurance companies. On your compounds, you are not taxed only until you decide to withdraw the full amount. Then you will be taxed. It is highly recommended to look and fully study annuities only until you're comfortable with your retirement account. Bottom line is, thank you for watching, and once again, all investment and all investing involves risk, and you should understand the risk before investing in any investment type. And any information from this presentation should not be used as investing guide or financial advice to anyone. This is just simply explaining what is available to you. Thank you.